Becoming a millionaire must be a complicated process, right?
Wrong.
It's actually so simple that you can get it set up regardless of your investing experience, and you can really get it set up on autopilot. This way you can just sit back and relax and spend your time doing the things that you enjoy doing. In this video, we'll break down the standard 3-fund portfolio that is the bane of financial advisors' existence. Let's get to it. But first, if you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. The 3-fund portfolio consists of, wait for it, only 3 funds. The U.S. Stock Market Index Fund, the International Stock Index Fund, and the U.S. Bond Index Fund. Investing in these 3 funds gives you access to nearly every stock and bond that's available on the market. You'll hold over 20,000 stocks and bonds in total, and you'll do so while having 0 overlap. So these 3 funds are entirely unique from one another. Any holding within one of the funds will not be found in the other ones. There are different versions of set it and forget it portfolios that will grow your wealth over time. As an example, I personally don't hold any of these 3 specific funds that we'll be discussing today, and my portfolio mix has outperformed the 3-fund portfolio and the S&P 500 each of the last 9 years. And we'll dive into that at the end of the video. We'll show some backtest comparisons. And of course, my portfolio mix is a collection of passively managed, low-cost ETFs. So this isn't me trying to be a mastermind, hand-picking stocks and trying to time the market. It's the exact same concept as the 3-fund portfolio that we'll dive into in this video. It's buy and hold forever and cost average in. And with that said, past results are not necessarily indicative of future performance. I strongly believe that a 3-fund portfolio is a great solution for the majority of people, probably myself included, for the long haul. And I can say with certainty, the 3-fund portfolio will absolutely outperform the vast majority of portfolios managed by a financial advisor, with fees included, over any long stretch of time. Okay, and I just got to get this out of the way. Before we dive into the specific funds we're going to pick, I'll just throw out my disclaimer here. I'm a huge fan of Vanguard funds, and I personally like ETFs, which are slightly different than index funds. We won't get into the details. It doesn't really move the needle that much, but I personally like Vanguard ETFs for tracking markets. And I like Vanguard because they're available on all platforms. A lot of the Fidelity ones or Schwab ones or other ones are only available on their version's only available on their platform. Vanguard's fairly universal. They're generally very low cost, and then of course these are all passively managed. But this is just a little disclaimer to say you can pick a different ticker symbol to do the exact same thing. I personally go with Vanguard ETFs. All right, let's dive into Fund 1 of this 3-fund portfolio. Okay, so Fund 1 is the Total U.S. Stock Market ETF. And again, I use Vanguard for this, and I use ticker symbol VTI. And that's Vanguard's fund that holds every single U.S. stock. So there's currently 3,883 stocks that it holds. And this number changes, of course, as companies come and go over the years. And it has an extremely low expense ratio of 0.03%. And this is fantastic because it keeps the money in your pocket over the years as the compounding effect comes into play. And then the dividend yield, some of these companies pay dividends, some of them don't. But overall, the dividend yield on those 3,900 stocks is about 1.5%. Okay, Fund 2, and this gets about a 10% allocation in this 3-fund portfolio, and it's the Total International Stock ETF. And this is ticker symbol VXUS, and it has 7,964 non-US companies throughout the world in emerging markets. And its expense ratio is very low for an international fund at 0.07%. And its dividend yield currently sits at around 2.81%. Fund number 3, which is about a 10% allocation, is the Total U.S. Bond index fund. And for this one, I used the ETF from Vanguard BND. And it has about 15,000 holdings. And its expense ratio is razor thin. Just like VTI, it's 0.03%. The dividend yield in 2022 was 2.23%. This will vary over the years as the federal fund rate goes up and down, and the holding duration varies because there's so many bonds with different maturity dates. So it will be changing all the time, but in 2022 is around 2.23%. I promised earlier that we would take a look at how the 3-fund portfolio compares to my personal portfolio mix. And before we dive in, I just want to mention that this is not financial advice. This is for education and inspirational purposes only. Please always do your own research before purchasing any stock, ETF, or mutual fund. And before I dive into the screen share to show you the results, I wanted to just go through a quick checklist of why I personally don't own any of these 3 specific funds, but they are all fantastic funds. So to start, I personally like to hold VOO, that's VOO, instead of VTI. They're very similar. So VTI was the total US stock market, whereas VOO is the S&P 500. These are the 500 largest companies by market cap in the United States. And the reason I like VOO is that I like the way that as companies come and go, it will automatically weed through and only take the most successful, long-standing producing companies. So, inevitably companies do go bankrupt, things happen, and they fall out of the S&P 500. And then some companies come skyrocketing up, like Tesla. And actually, Tesla's a great example. When you hold VOO, you didn't get that huge come up when Tesla was a small company. And I don't think it made the S&P 500 until, I want to say 2021. I could be off a little on that. So with VTI, you got the benefit of Tesla just rising up from zero to hero, but you also hold a bunch of duds that never get off the ground. VOO ironically feels a little safer, even though it's technically, by definition, it's less diversified because it doesn't have those small and mid-cap companies. I like just having the top producing companies that usually have more longevity attached to them. It's personal preference, and really VTI is made up of about 85% of VOO. So the entire holdings of the 500 of VOO, which has probably 508 holdings usually at any one time, all of those are in VTI, and they make up about 85% of VTI. So the other 15% you get are the small, usually more volatile, so higher ceiling, lower floor companies with VTI. And I will say VOO has slightly outperformed VTI on total returns over the past 1, 3, 5, and 10 years. When you zoom out 25 years, I think they're neck and neck. So really just take your pick. You can go VOO, you can go VTI, you can get both. It doesn't hurt to get both. I mean, it's not necessary, but there's no reason you can't do it. And then I don't have an international fund that has all the non-US stocks, mainly because there's a lot of business done internationally with the S&P 500 companies. And I feel that gives me the exposure I'm comfortable with outside the United States. I will say I've been considering it more and more just to get actual international stocks in the changing world that we live in, because just because it hasn't been quite as good the last decade plus, that doesn't necessarily mean it's not going to outperform in the future. So I have been on the fence, and I am thinking about slowly getting a position. As of right now, it's not in my mix. And then I don't hold the total bond index because I think there's better alternatives for younger people, older people, and everyone in between. And I'll explain that a lot more in future videos, and I'll touch on it as I show the back testing in this video. Okay, the moment you've all been waiting for. My secret formula is an equal mix of VOO, SCHD, and VGT. And let's dive into the back test as I explain this. What we have on the screen here is Portfolio Visualizer. It's a nice website where you can backtest different portfolios against one another. And what I've done here, I've already put this in to save us a little bit of time. So I'm doing the last 10 years, and that's 14 through 23. We're putting a starting amount of $10,000 into the portfolios. We're not going to be making any additional contributions. It'll rebalance annually. The dividends will be reinvested. So this is something we're working on building over the years, a very realistic situation. Everything else is sort of default here. So what I have is portfolio 1 is the 3-fund portfolio that this video has been discussing. And you can see 80% of it is VTI. International exposure is 10%, and then the total bond is 10%. Portfolio 2 is the portfolio that I personally use. And you can see, I can't make these exactly a third each. I just made the market, VU, 34%, which is the S&P 500. And then SCHD and VGT, I made 33%. So they're very close to a third each. And then speaking of the market, which is VU, the S&P 500, that's portfolio 3. If you were to stick all your money in the S&P 500 instead of using this variety of funds. A lot of people do prefer this. We'll get more into that in future videos. So I am going to hit analyze. And let's see the results. So here's that portfolio 1, the 3-fund portfolio. Here's my mix, and here is just the market. And as you can see here on the performance summary, the 3-fund portfolio has a CAGR, which is compound annual growth rate, of about 9%. My mix has been 14%. And portfolio 3, which is the S&P 500, is up about 11%. So pretty impressive results across the board. What you might find interesting is the best year is the highest on this portfolio 2. The worst year is the best, so the least amount of losses on the same portfolio. And I'll explain why it works like this. And then Sharpe ratio and Sortino ratio, the higher the number here, the better, the more stable. So it might seem impossible, but this portfolio is more stable and less, it fluctuates less with the crazy markets. It has the best worst year. It has the best year and the highest overall. And you'll notice further, and you'll see how they trend very similarly to one another, and that's just how the market works as a general rule of thumb. You can see they go up and down together. But really when you get into the annual returns here, you see the red bar is my mix, the blue bars are 3-fund, and the yellow bar is the market, the S&P 500. In 14, the red bar won. Same concept with 15. In 16, it looked like a decent year for the market, and it won. Really high years these years, and it's the highest. Everything lost money in 18, and everything really lost money in 2022. This is a good example of a bear market, kind of a rough year for everything. You can see though you lose a little less money and you gain more money. It's a nice mix, and really this is just the quick and dirty version of why it works that way. One more trailing returns. Okay, and you can see some like shorter snapshots. These will vary a little. Year to date, you can see portfolio 2 is ahead. 1 year, it's ahead. 3 year, it's ahead. 5 year, it's ahead. And full, it's also ahead. And the reason that you beat the market every year, and nothing's guaranteed, just to be clear in the future, but VGT is an ETF that is based on 100% tech stocks. They have at least some association to tech at every holding. So it can be a wild card. In 2022, it was down 30%. It was right here if you just looked at VGT. But in a down year, SCHD is a more conservative dividend ETF, and it has some good growth to it as well. In fact, my next video is going to break down SCHD and why I include it in my portfolio mix. So it carries the heavy losses of VGT, overall, when you net them together, you slightly beat the market. And the same is true on the up years. VGT is sky high on these years, and SCHD is usually more conservative growth, if any at all. But when you net them together, they weed out, they take the best of the S&P 500. There is a little bit of fund overlap, actually not that much though, and we'll dive into that too on a deeper dive. But I just wanted to show you there are ways to consistently beat the market, and mine isn't the only way. You just need to be careful that you approach it in the right way. If you're entirely based on growth stocks and you're absolutely crushing the market, don't get too high, because as soon as you have a year like this or like this, your bar is going to be down here. That does it for this video. Thank you for watching, and if you enjoyed the video, please give it a like and tell a friend about it. It really helps get the channel out there and helps me grow this thing, and I really appreciate you. Have a wonderful rest of your day, and I will see you here next week. Peace.